We've talked about the markets, we've talked about the Fed. What's the economy telling us?
Well, the economy has two parts to it, obviously. One part is what real GDP is, or auto sales. Then there's inflation. And inflation is by far the more important part right now. But on the first part, the economy is doing okay. As you know, we survey companies, and our retail survey dropped sharply this week, but still pretty elevated. Housing is really getting hit. But on balance, the economy is doing okay. I think it's probably growing 2 or 3%, but headed to 1%. The rig count, bank loans came out this afternoon, and they're up 11% now. And retail sales this week were, pretty decent. On inflation, which is much more important, I'm pretty convinced that inflation is slowing. Oil prices came down, gasoline prices came down, and in the weeds, used car prices dropped about 3% in the latest month. And we survey retailers' pricing power. That's now plunging. You've heard the stories about the inventories being high, and we have been tracking that for a long time. It's now really coming down. But the most important part, and we don't get much data on this, are wages. And obviously the labor markets are very tight, but they had, from the conference board this week, a measure of CEO confidence. It was almost a record low. And then another survey that showed 80% of workers were concerned about losing their job. Go figure that. But we survey employment agencies every week and ask them, among other things, about wage pressure, and that's now pretty clearly hooked down. So I think you're beginning to see some moderation in wages on top of prices now cooling and the economy's cooling.
So Bob, Ed sees inflation starting to come down. The question is how fast it's coming down, but starting to come down. How do you see it? And is it coming down enough and fast enough so the Fed will not have to go much further in rate hikes?
It's definitely on the down, but the question is, where does it settle out? And does it settle out at the level that the Fed expects it to and that the markets are discounting? The markets are discounting 2.5, and we're coming down from 6, or higher on the core, right? So, but there are really two big imbalances in the economy right now that need to be resolved through this tightening cycle, and we're still in this tightening cycle. It's too early to really see the effects. It hasn't been that long to see the effects, and so chances are you're going to get more of that weakness as you go along. But there are two big imbalances in the economy right now that are going to have to be resolved. One is the level of nominal spending in relation to the output capacity of labor. Over the past year, nominal spending is up 10%. And incomes are up 10%, and if incomes are up 10%, that gets spent, and you get more spending at 10%. So you got to bring incomes down, and if incomes are growing by 10%, but labor can only produce goods at the rate of 4%, you get a 6% inflation rate, and that's the first imbalance, and that's the basic cause of the inflation that we have right now. It's really not the supply chains, it's just too much spending. Which came from the monetization of government debt and the fiscal stimulation. The second imbalance is the level of nominal spending in relation to bond yields. So nominal spending is even higher above bond yields than it is above output. It's 7% above bond yields. So it's the highest in 60 years. So if people's incomes are growing well beyond bond yields, it's very easy to make debt service payments. And even if you lose your job or commodity prices go up or something, you can get credit. And so the credit numbers that Ed's referring to, loans up 11%, that's a backstop on the economy and spending. So it's the high level of spending and income in relation to interest rates and labor production, and it's the availability of credit to sustain that. And that all means that you have to get a tightening of monetary policy and a sustained tightening of monetary policy to bring about an equilibrium.
So it strikes me that Bob brought us back to wages pretty quickly there. That's one of the issues here of wages. You said that's the hardest to get your arms around. Where are we with wages and that wage price spiral? Because in fact, if we are going to have continued inflation, people are going to want to make more money. They're going to go to their bosses and say, you need to pay me more.
Well, CEOs now are really bearish, so they're not going to be happy if you have a CEO on. But Bob and I think about the same way. But money growth has been slowing for about 18 months.
Well, talk about that, because it was growing gangbusters for a long time.
Right.
But you're saying it's turned around.
So in the conventional way, you had the checks, you had quantitative easing and low interest rates. And so money growth got up to almost 30%, which is obviously extremely fast. And that's why you have the strong nominal growth. Now, with figures I got this afternoon on bank deposits, money growth is well less than 5%. And so we've set up the mechanism for this nominal growth, which is way too fast, to slow down. But that's what has to happen. And obviously, this is a really interesting thing. If it slows down, does it come out of real growth or out of prices? If you have your 10% nominal growth, which everybody can understand, I think, right now it's about 1% real and 9% price.
Right.
And if you go to, say, 5% nominal, what's the mix then?
Right.
But if you take that much money supply away, if the money supply has really gone down, should that fix the inflation problem, or at least take us a long way toward fixing it?
Your total in an economy, your total sources of funds is your sources for spending. And there are three sources. There's money, there's credit, and there's income, right? And so when you get to tightening of monetary policy, they're contracting money, and that's absolutely right. The first effect of a contraction in money is on asset markets. Because if you think about the printing of money by the Fed or any other central bank, they print the money and then they go buy bonds, or they print the money, and that money then goes into stocks. So that money most directly affects the financial markets. Credit more goes into spending, right? Because you take out an auto loan to buy a car, you don't take out an auto loan to buy a bond. And the Fed doesn't print money to buy a car, they print money to buy financial assets. So what you have is a push-pull where the contraction in liquidity from the central bank is a drag on the financial markets, while the expansion of credit is a support to spending. And so you got that working in both directions right now.
Well, but that's interesting to me, at least. Credit's going up. That sounds like it's good. It's going to spur growth. But that makes it sound like that's actually going to make the inflation situation worse. Does the Fed need the credit to come in?
So probably. So in my view of it, which is a straight Milton Friedman take of it, of those three pieces that Bob pointed out, the first one is where it starts, is the money growth. And I track global short rates. It's a global economy, and they have a higher impact on the U.S. economy than Fed funds. And they've been going up for about 18 months, same time that money growth has been slowing. So I think we're pretty deep in this. And we had a pretty good drop in the stock market, to your point. And now inflation's coming down, and the markets are beginning to think that this is introduction to the next chapter, the next peel of the onion.
He's exactly right. So the money's the first thing, right? But and money's the first thing, but it needs to get to the second thing and the third thing to have the permanent effects, right? Which means you have to be in a tightening cycle for long enough for that to happen, right? And we've been in a tightening cycle for how many weeks, right?
If you look at global rates,
you're right, 18 months,
yeah,
exactly.
Right.
But you have to be in it long enough, right? And so, as we look forward, we think that there's going to be, it's too early to tell, really, how this plays out in terms of whether it's weak growth or high inflation or which one. But you're probably going to get some combination of weak growth, high inflation, and rising interest rates. Right. And all three of those are rough on asset prices. And the mix is going to be determined mostly by how aggressively the Fed and other central banks tighten and stay tight if they have to pay the price of a downturn.